This is one of the charts that made me rebalance my entire portfolio. The S&P 500 overlaid with the inverse of the MOVE index. Bond volatility is climbing and the S&P is completely ignoring it. That is a divergence I have seen before and it did not end well. When I was trading institutional flow, we had a rule. You never look at a single chart in isolation. You always cross-reference it. And right now, when I cross-reference this with what I'm about to show you, it tells a story that concerns me greatly. Now let me show you the S&P 500 on a clean daily chart. This is important and I have been tracking this pattern for most of my career. But first I need you to keep this chart in your head because in about 3 minutes I'm going to show you a second chart that when combined with this one changes the entire picture. It is the scariest chart I'm watching right now and nobody is talking about it. By the end of this video you will see exactly what these charts are telling me to do with my own money, and I'm going to show you the exact framework I use to decide when to raise cash and when to deploy it back. Now let me show you why the measured move pattern is so powerful on a daily chart. This is something we used on the desk and once you see it you cannot unsee it. Look at this, the red rectangle, this was the post-COVID rally from 2020 into 2021. The S&P doubled from the bottom and then it exhausted. The correction that followed was almost exactly the same size as the initial rally leg. Now look at the second pattern. The yellow rectangle, same thing. The market rallied, consolidated, measured the move, and when it hit the exhaustion zone, it corrected again, mechanically. And now look at where we are today, the third measured move. We are sitting right at the upper boundary of the exhaustion zone. The thesis suggests we are within striking distance of the same mechanical exhaustion that ended the last two rallies. Now, this pattern alone is already a warning, but what I'm about to show you next is what made me act. Because when you combine this pattern with leverage data, the picture goes from concerning to alarming. But first, there is one more thing about this chart I need you to remember. Because it comes back at the end of this video when I show you the exact strategy I'm using right now. I have been doing this for over 15 years and what I'm about to show is one of the scariest charts I'm tracking right now. The danger is not how high this market went, it is how they bought it. And it is why I made the decision to raise my cash position in the last few weeks. This is the FINRA margin depth chart going back to 1998. The blue bars are total margin depth, the red line is the S&P 500. Margin depth peaked in January of this year at $1.22 trillion. It has come down slightly, but it remains at the highest levels in history relative to the overall economy. But this is not the scary part. The scary part is the next chart. This is the chart I mentioned at the beginning. FINRA investor margin depth relative to M2 money supply. Not nominal depth, leverage relative to the actual amount of money in the system. This is how we measure it on the institutional side. As of April 2026, this ratio is at 5.64%. Let that number sink in. That is the highest level since the dot-com bubble. The last time we were here, markets corrected 49%. Keep in mind, past results are not indicative of future performance, but the pattern is worth studying. Now we are getting to another part that made me change my portfolio these past weeks. Because what comes next is what amplified this leverage to these levels, and it happened on a very specific date. This is the Chicago Fed National Financial Conditions Index. Negative values means loose conditions. And look, on April 1st, 2026, the new eSLR rule went into effect. This rule reduced the capital banks have to hold against low-risk assets like treasuries. What that means in practice is that banks now have more balance sheet capacity to extend leverage. If you watched my previous video, we explained this in detail. The timing is critical. They introduced more leverage capacity into a market that is already at peak risk appetite. Now look at this. When the bull line starts increasing, conditions are tightening. Less credit, less leverage, and that means turbulent times for stocks. Right now I'm watching for that bottom pattern in the NFCI to form, because when it turns up, that is your early warning. But there is leading indicator that tells you before the NFCI moves, and this is something that took me years on the trading desk to fully understand. The United States dollar. Look at the correlation. The dollar leads financial conditions. When the dollar strengthens in the FX markets, it tends to tighten financial conditions, which has historically been associated with stock market corrections. The dollar is above 99 and it is climbing. In a very indebted, leveraged economy, cash is not always trash. When liquidity tightens, cash becomes your best weapon of choice. And I'm going to show you exactly how I think about that in the final section of this video. Now, and this is critical, the pressure is not just domestic. This is where most YouTube analysts stop. But on the institutional side, we always watch the global picture. And right now, Japan is the wild card that could accelerate everything I just showed you. The Japanese 10-year bond yield has exploded to 2.73%, the highest since 1997, and their benchmark interest rate is still at 0.75. Look at this chart. The gap between Japan's long-term yields and the yen has never been wider. The BOJ is expected to hike to 1% in June. If they do, it could trigger a carry trade unwind, and Japanese investors hold roughly $1 trillion in US treasuries. If they start selling, our yields go higher and our leverage problems get exponentially worse. Now let me be direct with you, because this is the part that matters for your life, not just your portfolio. When $1.3 trillion of margin debt sits on top of rising yields and a strengthening dollar, it hits your retirement account, it hits your mortgage rate, it hits your purchasing power through inflation that the Fed can't cut its way out of it. And this is exactly why I raised my cash position before the data I'm about to show you even came out. Because when you have sat on an institutional desk and watched these cycles play out, you learn to move before the headline, not after it. Which brings me to the data print that confirmed my decision. If this is the first time you are watching this channel, I break down these macro signals every single week using raw data and primary sources. No hype, no clickbait, just the numbers and what they mean. If that is valuable to you, subscribe, because the data I'm tracking right now is going to evolve fast over the next few weeks and I will be covering it. The US 10-year Treasury yield. In previous videos, I warned you to watch if it breaks above 4.5%. It just did. The 10-year is now at 4.6%. And it is not just the United States. 30-year yields across the UK, Germany and Japan are all rising in a tandem. This is a global phenomenon. Bond markets around the world are telling you the same thing. Inflation is not beaten. And look at the 2-year yield, 4.08%. That is above the Fed's target rate of 3.5 to 3.75. So the market is pricing in a Fed that stays patient or potentially even hawkish. CPI came in at 3.8%, PPI at 6%, and these numbers are moving in the wrong direction. Look at the Fed Watch tool. 98.7% probability the Fed holds in June. No cuts are priced right now. And compare this to what we showed in the last video. The probabilities have shifted hawkish after the hot CPI and PPI prints, exactly as we were warning. And then there is this, and if you take nothing else from this video, take this chart. Goldman Sachs risk appetite indicator is above 1, and the United States equity momentum z-score is above 3. This combination has not been seen since the year 2000. Let me say that again. The last time risk appetite and momentum were both at these levels, it was the dot-com peak. However, and this is important for context, in 1999, after the same signal triggered, equities continued rallying and rising for nearly 12 months before the correction. So this is not a timing signal, it is a fragility signal. It tells you the system is stretched to the breaking point, but it does not tell you the exact day it breaks. And that's exactly why the strategy I'm about to show you is more important than any single chart in this video, because it is not about predicting the exact top. You cannot do that, nobody can. It is about being positioned correctly when the music stops. Now, I genuinely want to know something. Are you raising cash right now, or are you staying fully invested? Drop your current cash allocation in the comments. 5%, 20, 50, I rate every single one of them. And I want to see where this audience stands, because the answers tell me more about market sentiment than any survey. Now let me tell you exactly what the bulls will say. They will say artificial intelligence is driving a productivity revolution, that corporate earnings are strong, that the eSLR change actually helps banks stabilize treasury markets, making the system safer, not riskier. And if inflation was heading back to 2%, they might be right. But look at this. The free cash flow margin of the hyperscalers, Google, Microsoft, Amazon, are declining a lot, from 20% in 2019 to essentially zero by 2026. They are spending hundreds of billions on AI infrastructure, and the returns are not there yet. This is pressure, not strength. However, this is not a recommendation regarding any individual security. I'm not a financial advisor. Do your own research and your own due diligence. And the cost of carry matters. Margin loans have floating interest rates. Investors are paying 8 to 9% on brokerage debt, so if the market goes flat, they lose money every single day. However, if inflation moderates back toward 2.5% and the Fed begins cutting by late 2026, this entire framework collapses, because cheaper money would sustain the leverage cycle for longer. That is the risk to my thesis, and I'm watching for it. So this is what I promised you at the beginning, the part that actually matters, the actual portfolio management. How I think about risk and what I'm doing with my own money right now. So when the measured move pattern approaches exhaustion and leverage is at record levels, I do not panic sell and I do not go to zero. That is the amateur move. What I do is dynamic rebalancing. I set strict bands for my core cash position. In normal conditions, I hold 5% cash max, but when risk metrics enter elevated territory, like right now, I scale that up to 30%. The psychology of that is critical. If an investor is 100% invested and the market drops 15%, the psychology of regret and fear of missing out can push people to sell at the bottom or buy at the worst possible time. But if I have cash, I can scale in on pullbacks, I can scale out on rallies, I let the market come to me. That is the framework I use. So watch the 10-year yield, watch the dollar, watch Japan. If the 10-year breaks above 4.85, the thesis suggests the math on $1.3 trillion of margin debt becomes very difficult to sustain. And when conditions improve, when valuations become attractive and financial conditions ease, that is when I would consider reducing my cash position back toward 5%. This is not about predicting the top. Nobody can do that. It is about managing the risk when the data tells you the risk is real. So watch the 10-year, watch 4.85, and see you in the next one.